Hello, I am Piyush Dave, a fintech professional, and today I'm going to share one more algo trading strategy using the method called as the VAMA. First, I'm going to explain each part of the VAMA, the calculation which has been involved with VAMA, and after that, I'm going to show this complete strategy in the simulation environment. You can try this in a real market also. It works well. I try and tested it many times. And in a simulation environment also, it works very well. So first part is how this VAMA works. So the V is stand for volatility, moving average, MA is for moving average. So moving averages keep on changing as the volatility changes. If the volatility is high, the moving average become fast. So let's consider the moving averages of the 5 candle. And if the volatility is low, the moving average becomes slow. Let's consider of 20 candle. So moving average continuously switch between 5 and 20. I have taken a random number. You can take then 10 and 20 also, 30 and 50 also. So faster moving average means small number of cycle and slower moving average means large number of cycle. That is the meaning of VAMA. So first we will take the volatility into consideration, and based on that there's a continuous switching between faster and slower moving averages. Now what is the trade setup for the VAMA? First we will collect the price from the market, then we will calculate the VAMA from that price, and the long entry will be taken if the price go above VAMA, and this VAMA is also been updated with this price. If the price go below VAMA, we will going to take a short entry. And when to exit a long entry if this condition get reverse, and when to exit the short entry when this condition get reverse. So we are going to exit when the condition of price greater than VAMA is reverse in the long entry, and we are going to exit when the condition of price less than VAMA reverse in the short entry. So that is a logic behind it. We are going to trade with fixed number of size, and that is 100 quantity. So it's a dynamic moving average, continuously adjust as per the market volatility. It basically switch from the faster moving average to slower moving average, and slower moving average to faster moving average. Now why not other moving averages? Here very special factor called as a alpha has been used to get the smoothing factor in the VAMA. If you see the actual mathematics which has been involved in the VAMA is have the great level of accuracy. Then why not SMA or EMA and WMA? That so it's depend on what kind of a trade setup you have. So VAMA does not have the fixed factor. It has a variable factor, and other like SMA, EMA and WMA have the fixed factor. So smoothing factor is fixed in other methods, and VAMA does not have this factor. So now due to that, it works very well with change in volatility in the market. So SMA is very slow. If there is faster move is coming, then even it is a lag indicator. So it move that miss. It misses that move. Or in the EMA, we can consider it's faster, but still in a volatile market, it won't work. And WMA works very bad in low volatility. But VAMA works in low volatility also. And VAMA works with high volatility also. So that's a special part of the VAMA. I already told you VAMA is the best work with volatility, but EMA and SMA does not consider that. And WMA become very weird behavior when the volatility is very low. Noise filtration is excellent in VAMA because it uses the adaptive alpha. Adaptive alpha means it change the alpha whenever required. Then it become fast and slow whenever needed. It works very slow, it works medium. So the speed of VAMA changes as per the change in volatility of the market. It has the high lag, medium lag and lowest lag in the VAMA. Then it is suitable for algo trading. The yes answer is yes. Some people uses SMA as a mean reversal technique. EMA can be also used as a mean reversal technique and it also works in algo. But VAMA works excellently in the mean reversal technique also and other technique also. Okay, now let me show you the exact calculation happen in the VAMA. So these are the 20 readings I have collected from the market. So these are the price of each candle close, or you can consider this is a price which is coming continuously in the market. We will add all this price and divide by 20 reading. So that is going to give me the mean of these 20 readings. So this 20 reading will be added, divide by 20, divide by 20 because there are 20 readings. So we get the mean of, and mean is 114.8. We will subtract the first price from the mean and we get this is deviation. Then we are going to square that. Why we need to square this error? This is called error between the mean and exact price. Why we need to square this? Otherwise, if we don't square this, one value is plus, one value is minus. It basically, if the values are same, then there is a zero impact of it. So that's why we need to square that so that the error will not be negative. Once we get this value, we are going to get the addition of all this. This is called sum of square deviation. This is called deviation and the sum of all deviation. Then the sum of all deviation is basically called as a deviation for only this 20 readings. So this 20 readings, if I use a standard deviation formula, so standard deviation formula is square root of sum of square of all deviation divide by 20. So it give me the standard deviation of these 20 readings. Okay, let me explain this one more time, then it will be very clear. Let me explain that. Okay, so we have 20 reading in the market. First step is to add these all readings, then divide by 20 because we have 20 readings. So we get the mean. Once we get the mean, we will subtract the first price from the mean and we get some deviation from the mean. We cannot use this deviation as a negative, so we have to square this. So I just square the deviation. After that, we are going to add all this value. So this is going to give me sum of all square deviation. But we want standard deviation. So standard deviation is this value, the sum of all deviation, square root of divide by number of readings, 20. So this come out to be 7.62. Once we get this, we need to calculate alpha also. Why we need alpha and why we need all these values? The reason behind the formula of VAMA. Let me show you that. Formula of VAMA, I have that in the table. So the formula of VAMA is alpha into price plus 1 minus alpha into VAMA. So first we need to know the alpha. We need to know 1 minus alpha. So that's why we need to first understand what is the value of alpha. So alpha will be calculated from the volatility divided by the average volatility. So now this is the average volatility. The standard deviation is considered to be as average volatility. So currently we have both the value as 1. Volatility is also 7.2 and the average volatility is also 7.2. Now why both of them are same? Because it's the first reading, first cycle of the reading we are getting. After the second cycle, the volatility might change and average also get changed. So that's why we get the different value of alpha. Now currently we are getting a alpha as 1. But there is again rule for this. Alpha we cannot take as 1. The max value of alpha is between, let me show you that also. The max value of alpha is between 0.02 to 0.20. It's a standard value decided previously. So what we are getting alpha from the calculation is 1. So mathematically it is correct, but smoothing curve cannot be 1. Otherwise, if I put this 1, then the VAMA equal to always be price. So there will be no smoothing happening. It become extremely fast and extremely sensitive to all the change in the price, which is a useless. So we need to find out the alpha in a particular range. So what is the deciding factor? So if you want very slow smoothing, low volatility, then we choose the alpha as small value. When we want fast smoothing or fast volatility, high volatility, we basically choose 0.02. The value of alpha cannot be above 0.02. So we are currently getting the value as 1, but max value is allowed as 0.2. So that's why we stick to 0.2 only. Now the first part is, suppose we get the alpha as 0.8 also, we were going to choose to 0.2, 2.5 also 0.2, 0.1 and 0.1 is okay, 0.01 below the value of 0.02, it's not allowed, not allowed, not allowed. We are going to allow the only value between 0.02 to 0.20. So if the values are high, we are not going to choose that. If the values are low, we are not going to choose that. Value is high, we will stick to this. Values are high, we will stick to this. Value is low, we will choose this. Value is in the range, not low, we can say it's in the range. Value is low, we will choose the range. So the high value of alpha is 0.02 and low value is 0.02 and high value is 0.20. Okay, now if the 21th reading come, we get the new VAMA. The answer is yes, for sure. So every time the new reading come, the VAMA is get updated automatically. Now let me show you how the VAMA is been calculated. So VAMA is alpha into price plus 1 minus alpha into VAMA, previous value of VAMA. So first VAMA is not available, so VAMA we will copy it from the first reading. After that, suppose the alpha we choose as 0.02. So 0.02 multiply by the price multiply by the 1 minus alpha multiply by the price, because the first price and the VAMA is same. Now in the next price it is more logically visible. Let me show you that. So this is the formula. Okay. First alpha. So this is the value of alpha. Okay. Second reading will. This is the value of alpha. This is 1 minus alpha. This reading is been taken. This reading is been taken from here. This value has been taken from here. So this is the price and this is VAMA. Again, This value has been taken from here and this value is from here. Again, this value is from here and this value is from here. This iteration go on. And finally we get, after 20 reading, this is a final VAMA. By considering the alpha as 0.02, because the 20 period cycle average volatility is 7.62. And now this alpha we can choose between 0.02 and 0.20. Now based on that, we basically get the final VAMA. Now once we get the VAMA, our trade setup is ready. Now let me explain this complete part one more time. Let me open this PDF again and explain this one more time. First part is, what is the meaning of VAMA? What is the meaning of VAMA? VAMA is Volatility Adaptive Moving Average. So moving average is get changed when there is a change in volatility. Volatility is high, moving average fast. Volatility low, moving average is slow. Next, if the price is above VAMA, we will take a long entry. Price below VAMA, we will take the short entry. And exit is opposite to it. I'm just giving you the summary. Then it is better than the SMA, EMA and WMA because it uses the very important term called as the alpha. Now for other methods, this alpha is constant. For VAMA, the alpha is keep on changing because alpha has been decided by the standard deviation. VAMA works excellent with the algo. That is what the summary of this table. And first we will collect all the 20 price from the market. This 20 price may be the candle of 1 second, maybe it is of 1 minute or 1 hour. Whatever you want, you can choose that time cycle. Then this is a 20 price which we have collected, sum of it, and divide by 20. So we get the average, mean. Then we will subtract the price from the mean. We will find the square of it. We will find the sum of all the deviation, and the standard deviation will be calculated from the sum of square of all value divided by 20. So this is the standard deviation. Once we get the standard deviation, we need to find the alpha. So alpha is volatility divided by average. So here the volatility is also 7.62 and average volatility is also 7.62 because we have collected just only one value of 20 cycles. If one more value comes, then volatility also get changed and average volatility also get changed. Now due to that we are getting the value alpha as 1. Now if I keep this alpha value 1 in this formula, then this becomes 0, which we don't want. So that's why we need to choose alpha very scientific way. If the alpha is been chosen near to this, it works very nicely with the low volatility environment. If the alpha has been chosen at 0.20, it works very good with the high environment. The alpha cannot be above 0.20, otherwise the algo will overreact. Here for our case, we are getting 7.62 divided by 7.62, so it comes out to be 1, and we don't want that 1 value in the VAMA formula. If we keep that 1 value in the VAMA formula, then the market is going to overreact. The algo is going to overreact. Now due to that, we have to cut down that alpha value to 0.20. So if the value is of the alpha is 0.80, still we are going to choose 0.20 only. Value is above, we are going to choose this. Value is in a range, we are going to choose the value which is actually alpha. If the value is below, then we are going to choose the above value only. After we get the value of alpha, after deciding the value of alpha, we are going to work with VAMA. See, the standard deviation, other calculation, you can directly skip. Directly, you can choose the alpha value between 0.02 to 0.20, and it keep on changing as per the requirement. So we don't need to actually choose manually the value of alpha, but I try to show all possible calculation. So first, the formula alpha. So alpha, the price, then 1 minus alpha, and the previous VAMA. Similarly, the price, VAMA, alpha, 1 minus alpha. And this way we are going to get the VAMA at the end. Once we get the VAMA at the end, we use this VAMA for the volatility calculation. We use this VAMA for what we can consider for the trade setup. Now let me show you that in actual trading environment. So this is the exchange which we have created, which keep on changing the price, randomly. We don't have any control over this change in price. So this is my exchange. It keep on changing the price. I have no control over it. So now let me start my algo, which basically calculate the VAMA value. So first we will have the warm up cycle. So it collect the price from the market. It's collecting the price from the market. Let me expand this window. This window also I can expand. I have a lot of space. Okay. So the price is keep on changing. And currently we are in a warm up cycle of 20 readings collection. So we can calculate the VAMA from it. So the process of VAMA calculation I already shown to you. Okay. Now let's see. Okay, the VAMA is been calculated. The alpha is 0.20. It has choose the alpha 0.20. Okay. The VAMA is okay. We have got short entry because the value, the price is below the VAMA. We got the short entry. We will exit this if the value go above. Okay, we just exit the algo because the price is above the VAMA. We were having a short entry. Currently also we have one more short entry. The realized profit is 600. You can even book the profit if you want. You can keep like 0.5% of the profit or 1% of the profit. Okay, we exit because the price above VAMA. We got the long position at, okay, we got again exit. Now we got a short position at 984. Okay, we need to exit again because the price is above VAMA. See, based on the sensitivity, it keep on doing this process. Okay, we got one more short entry. Okay, we exit the short position. See, like here we are getting a good profit. On that condition, if you want to book, you can book also. So you just need to change something in the setup of the trading. I have not kept that kind of a logic. I just kept a logic of if it get reversed, then exit the trade. Otherwise, don't exit it. So it won't give you the maximum profit. But I just don't want to book the profit. I just want to show that if the price is opposite to it, you should book the loss. That is the main reason. But if you want, you can keep the logic like this. We have long position at 988. You can keep the logic like this. If certain level of profit reach, book that. Okay, we have the short position at, okay, short exit also. Okay, we are in a current loss of 1200. It's completely fine. We got one more long position at 994. Okay, long exit because the price is below that. We got a short position. Okay, we have to again, and we have short long position in 995. You can do a small change in this, like if there is a huge profit, then book it. We got three huge profits, but we have not booked it. We were waiting. Okay, we got a long position at 1000. The price come below VAMA, then only we are going to book. Otherwise, we are going to run the profit. You can see we have good profit. If you want, you can book this profit also on the same line. Okay, we have the short entry at 1003. Okay, we book one profit for sure. Okay, we have the long position at 1007. We are not booking this. See here, it's continuously showing a level of profit. If you just change a small part in the algo, like you can book 0.05% or you can book 1% also. See, we are getting a good profit, but we are not booking this because I just want to run it till the price come below VAMA. Okay, we book 1000 rupees profit. We got a short entry at 1007. We are getting currently in a profit form. We will not book this until the price go above the VAMA value. Okay, we exit the position because the price above VAMA. We got, okay, we have to exit the long position. We got the short position again. See, the loss is been minimized. It works very beautifully. So you can change the logic in a way that if you get a good profit, you can book it. But I have not kept that in the setup because I just want to run with the logic of only VAMA. We got a long position at 1002. I just want to run my algo. Okay. It's not getting the price. Okay, it has got the price. Okay. There was a delay by the exchange itself. It's a real time situation. Okay, we got one long position at 1009. Okay, we are running. You can see VAMA is also changing. VAMA keep on changing with the new price. And alpha is 0.02 because it has been calculated with the logic of standard deviation. Okay, we got one long entry at 10. Okay, we exit also 1006, one more long position. Exit because the value is below VAMA. If the market is trending in one side now, we get a very good profit. But market is going up, down. Market is not trending on one side. If market trend on one side, we get a very good profit. You can see here, market is trending on one side. The VAMA is been updated automatically. You can see if the market is trending on one side, we get very good. Okay, we exited the position. We got one more long position. We exit the position. We got a short position at 1032. We have to exit this position again because the market is trending on the upside. Okay, we got one more long position at 1032. Okay, short position at 1032. See, it happened so fast. Still, I kept a delay of almost 1.2 second. If you don't want this delay, in the real-time market, you can choose the tick size very small. But I just want to show you what is happening in the market. So that's why we got the short entry at 1032. It's running the profit. 1032. Once the value go above the VAMA, we are going to book. Otherwise, we will keep running. Okay, we book the profit. Whatever loss or profit, we are going to book that. We got one long entry at 1. Okay, we exited that also. We got a short entry at 1020. We exited at position again. Short entry at 10. Okay, long entry at 102. It is happening so fast, you can see. The market is trending between 2 to 3 values only. So that's why it's taking a lot of efforts to enter, exit, the logic. 1019 is a entry for short 1019. If the value go above VAMA, then only we are going to book the loss or profit, otherwise not. Okay, we exited the position. We are long. Okay, we have to exit this also. We are short at 1011. Market, if you see, market is not trending on any side. Market is going 10 rupees up, 10 rupees down like this. Okay, we got one short entry at 1012. The VAMA is at 1007. We exit the position with a 400 profit. We got one more short entry at 1005. So you need to keep on running this. Just a small change you can do in the algo, that if there's a big good profit is coming, you must book that. See here, we got one long entry at 1010. We are running our profit because the value is above the VAMA. Okay, value is below the VAMA, it's going to exit now. We got short entry at 10. Okay, we have a long entry at 1017. It's keep on doing this. See, it's keep on doing this. Long short entry, continuous basis. We have no control over this. We have only control over our algo. We got one more long position. See, we are getting a continuous profit, but we are not booking it. We want a profit. We want to run our profit. So that's why we are not booking the profit. If the market is trending on one side, we are going to get a very good profit for sure. So now currently we have long position 1024. It's happening so fast. Okay, we are still running our profit. I'm just running it so that either I should reach to 5,000 of loss, or okay, we got the very good profit in one trade only. The market is trend like very good upside. Okay, we got the profit of 1500 in just one trade. See, beautifully we covered the our loss. Realize. Okay, beautifully we covered that. Okay, we were getting a very good profit. We have not kept the cycle like book that. Okay, now this is also trading upside. We got a long position. We are going to book this if the price come below the VAMA value. Otherwise, we will keep running this. We will keep running this. Okay, we exit the position. We got this short position at 104, 1014, 1044. So it happens so fast. A normal human cannot do this. We need to depend on algo itself. This kind of a calculation cannot be done manually by human. We got a long position at 1045, 1045 long position. You can see the VAMA value is Till the value remain above VAMA, we will keep running this. I'm just waiting, otherwise that it should become 0, or at least it should reach to minus 5,000. Algo is going to stop at minus 5,000. But it won't allow you to go negative. If the market is trending in one side, it is going to give a very good profit. I've seen many times. It gives very good profit. So currently market, we have the short position at 1052. The market is going down. We have 1300 profit. Okay, we exit the position at 1100 profit. Good. See, it has got one more short entry at 100. Okay, we got a short entry. We got a long entry again. Market is coming up. We got a long entry. See how beautiful it's doing that process. We exited because the price has below the value. Long exit because the price is come below the value. See, the realized loss is now less. We got very good. We got very good profit 2 to 3 times, but we have not booked that. Okay, we have the short position at 1043. 1043. Okay, we got the profit. We just booked that. And you can keep running this. Small changes in the logic can help you more in this. You can combine the VAMA with other trading techniques also, but it works beautifully alone also. We got one more long entry. I'm just waiting. At least I should close this in a profit. So that's why I'm waiting. So we got the long entry at 1041. We have crossed our threshold. If the market come below 1051, then okay, we exit the position. Okay, we have the realized profit. See, we have seen minus 2.5%. Now currently we are 0.6% in the profit. See, it has made the loss. It has automatically gained that. Okay, now currently we are in profit of almost 1100 rupees, 1% of the return. Okay, so it works very beautifully. And even you can change the algo like book if you get 1% of the profit. Okay, we got 800 realized profit and unrealized is 600. We got a short entry at 1040. So you can keep on running. The worst part of the algo is also you have seen, and the good part also we have seen. So this is the best recording happened ever for the algo. The main reason is I have not done anything. Market was doing its work, going up and down. The algo was trading with the logic, no fear, no greed. Beautifully works the VAMA algo. So I hope this is clear to you. Thank you very much.